In this video, we will learn basic accounting concepts. Actually, this is an introduction to accounting because here we don't discuss complex theories, just an introduction for the beginners. Now let's discuss what accounting is. Accounting is the process of providing information for interested parties. If you remember, in the previous video, we discussed interested parties. Different parties are interested in a business organization for different reasons, and they need some information, especially information about the money that they have invested in a business. Therefore, they are looking for some information from a business to make decisions. Therefore, accounting is important. Normally, there are two branches of accounting, management accounting and financial accounting. Accounting that mainly provides financial information is called financial accounting. Now here we are going to discuss some concepts related to financial accounting. Now let's discuss sub-objectives of accounting. Firstly, we should know whether our business has an adequate profit, whether we earn a profit or a loss. Also, we want to decide the financial position of our business. And businesses prepare accounting statements to fulfill legal requirements. In some organizations, preparing financial reports is mandatory. It is required by law. Sometimes people can forget some transactions that happened years ago. Therefore, accounting is important to arrange all the transactions. Look into the historical information and identify the historical balances. Now let's understand what a transaction is. A transaction is an exchange of resources between a business and other parties. Just assume you go to a shop and purchase two books. To buy those books, you have to pay. Then you will get two books. That is a transaction. You are receiving books and the seller gets money in return. Now look at the examples. Sales of goods for 100,000. Monthly salary payment of 50,000. Just assume the business is purchasing raw material from suppliers. Then the business has to pay for it. And in return, they will receive raw materials. When customers are purchasing, we receive money and they receive goods. Likewise, there are different types of transactions. Apart from transactions, there are some events that we consider in accounting. For example, damage to trade stocks and bad debts. What are bad debts? When we don't receive money from our debtors, the amount they owe becomes bad debt. Now let's discuss accounting elements. There are 5: assets, equity, liabilities, income, and expenses. Now let's discuss this in detail. Assets. Firstly, read the definition. An asset is a resource controlled by the business as a result of a past transaction and from which future economic benefits are expected to flow to the business. Just assume last year you purchased a motor vehicle, but still you are using it for product delivery. Then it is a result of a past transaction, but still you get benefits from that. Just assume you purchased a machinery in 2020, but you are still using it for the production process. You purchased a computer in 2022, still you are using it. Then those resources are called assets. For example, land and buildings, machinery, furniture, cash, equipment, stocks, debtors, and cash at the bank. Debtors are an asset to a business organization. Why? Because they are the people who purchase our goods on a credit basis. and they will repay them in the future. Therefore, debtors are an asset. Characteristics of assets. It is a result of a past transaction and is owned by a business organization and will give future benefits. We can identify two types of assets: current assets, non-current assets. What are current assets? The assets that are expected to be used, sold, or converted into cash within a short time period as 12 months in the ordinary activities of a business are classified as current assets. There are assets that we can easily convert into cash. Those assets are current assets. For example, stocks to be resolved, trade receivables, and cash. Stocks are items to be sold as soon as possible. We can convert stock into money within 12 months. Just assume you have bakery products. You are not going to keep them in your warehouse for a long time. Within 12 months, you have to sell it and earn money. Then it is a current asset. And debtors will also pay in the future, most probably within 12 months. So debtors are a current asset. Next, non-current assets. The assets that cannot be considered as current assets are non-current assets. For example, land and buildings, machinery, furniture, equipment, and motor vehicles. When it comes to these assets, we don't resell them within 12 months. Just assume you purchase a motor vehicle for your company and you are not going to sell it in the next year or within 12 months. You will use it for 5 years or 10 years. Likewise, we use non-current assets over the years. Next, liabilities. Firstly, the definition. Payables of a business that had arisen as a result of past transactions. Liabilities mean payables. Just assume you owe money to someone, that is a liability. Now let's discuss the characteristics of liabilities. Liabilities occur due to a past transaction. Assume that last month you purchased raw materials from a supplier on a credit basis. Now you have a debt to pay. You must redeem it. That is a liability. Outflow of economic resources. When you pay it off, you must spend money. Finally, current obligation. You must pay it. There are two types of liabilities: current liabilities and non-current liabilities. Current liabilities. Liabilities that should be paid off within 12 months are current liabilities. For example, trade creditors. When we purchase raw materials on a credit basis, we have to settle it within 12 months. And accrued electricity expense, also the same. If we couldn't pay our electricity bill last month, then this month we must pay it. Next, non-current liabilities. Liabilities that we have over 1 year to pay off. Just assume you got a bank loan and you have 5 years to pay it off. It is a non-current liability. Next one, equity. The value of assets that belong to owners. Income. Income can be defined as an increase in equity except for the increases from capital introductions by owners. For example, sales, interest received, and rent received. Here, there is a point that you should understand. Just assume the owner gives 10,000 to the business. It's not income because it's the owner's money. Then assume the business earns money by selling its product. That is income. Expenses can be defined as a reduction in equity except due to drawings. For example, salaries and wages, insurance expenses, cost of goods sold, and interest expenses. Drawings mean owners take money from the business for their private use. Just assume you have a business and you take 5,000 from the business to pay your house electricity bill. This is a drawing. The second scenario is that you take 3,000 to pay your company's electricity bill. This is an expense. Now here is an activity. Decide whether these items are assets, liabilities, equity, income or expenses. Take a few minutes and write answers. This is all. Thank you very much for watching.